In the previous video, we looked at some of the FASB, Financial Accounting Standards Board, parameter inputs for looking at or estimating the value of options. So what was required were the inputs were the expected term of the option. That could be an output of the model. In the case of the lattice, it was an output of the model, and then we finished with looking at the value of the employee stock option relative to the current stock price, and we could see that as the stock price went up, the current stock price, the underlying stock, as it went up, the value of the option went up as well. So there's a positive relationship between the two. Now, when we look at the actual FASB document, we can see the code here and the web link. The variables we must take into account are, yes, the exercise, the stock price, the current price of the stock, which we just have looked at, and then the expected volatility. So let's just go into our spreadsheet for a moment and rerun, set up another data table, but instead of investigating the effect of the value of the ESO relative to the stock price, we're going to change this and just look at the value of the ESO, the employee stock option, or the grantee stock option relative to the underlying current price. So okay, one way we could do this is just basically delete this out and start again. And in this instance, we say, okay, what was true? The true value was 27.85. When we used Hull White Boileau, the value we obtained was 27.86. That was just with 50 steps. With 500 steps, it would be 27.8675, which is consistent with what we have here. This is closer to the true value. In fact, if we put in 1,000, we can see that when we run that estimation, both the Hull White and the Hull White Boileau estimation are running together. But what we might observe is that the true value of 27.85.5, with 1,000 steps, we have 27.85.30, 27.85.30. That's consistent with the Hull White Boileau of 1,000 steps. But for the Hull White 2004 model, without any refinements for the barrier, without Boileau specifications, truncation, dynamic memory, we have 28.24. So let's just put that back to 500. Before we do that, we might note that the value here at 50 steps with Hull White Boileau is actually quite close to true. The 86 here, the 27.85.5, that's almost 27.86. And at 50 steps, we're quite close, whereas with the Hull White Boileau 2004, it hasn't converged yet. There's a lot of oscillation. So we can trim back that oscillation and sluggish convergence with the Boileau specifications. So what I'd like to do is, just because the FASB set out volatility as an input, just to examine what is the effect of increasing the volatility on the value of the employee stock option. Okay, so I go back to the Excel, and what we might do is just run, okay, initially set our employee stock option equal to this cell here. So we're replicating the 27.86, and then we're going to set out a data table where the inputs are 10%, 20%, 30, 40, 50, go up to 60, 70 perhaps, and then rerun the Hull White Boileau value employee stock option valuation with these inputs for volatility. Now, how do we do that? We go to the Data tab, we go to What If Analysis, we go to Data Table, and then the column here, because the data is arranged as column, we take the column input cells and then go back to the parameter here that affects this estimation here. So the original parameter for volatility was sigma 0.2. We highlight that there, it appears here, that cell reference, and then we run and it fills in quite quickly. We get 27 02 2786, and you can see that that value is consistent. So if we just highlight that value is consistent with the value that we have here, right? 2786.32, okay, we can map the relationship between the two. So go to Insert, Scatter Graph, and what we observe is the value of the ESO versus the sigma, which is the value we nominate here for volatility, and it's the volatility of the return of the stock. Right? It's not the volatility of the stock, it's the volatility of the stock return. So as we increase volatility here, it would appear that the value of the option would increase. Okay, so that's an interesting result, and we'll stop that here. In the next video we'll look at what's the effect of changing the maturity. Perhaps also just to mention, as we increase the risk, the sigma here, the level of risk increases, and as the variability of the stock price goes up, or the stock price return goes up, chances of executing, of making money increase. So the value of the option tends to go up by quite an amount. So we go from $25 up to $45. Now that would be less significant if we had started here at $20. The magnitude of increase would have been a little bit smaller, so we would have went from maybe close to $0 up to $5 if